Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Wednesday, July 22, 2026. We're Elena and Marcus. This episode is brought to you by Bank Atlas, where the risk of every bank is quantified via proprietary grades and analysis. Learn more at bankatlas.com.
Right, and we have a very complex setup across the board today.
We do. So, looking at today's data deck, we are essentially seeing a massive structural tug-of-war playing out across every asset class. We've identified three critical themes for you today.
Right.
First up, macro and rates. The 30-year Treasury yield is acting like a brick wall for the broader economy right now.
Yeah.
It's holding stubbornly above 5%. And meanwhile, the front end of the curve is pricing in a highly unusual risk of a Fed rate hike next week.
Which is severely dislocating equity markets, and that brings us to the second theme, sector and equity flows. You might look at the index level and see a flat market, but underneath that, it is a split screen.
Yeah, extremely violent under the surface.
Correct. We are seeing extreme momentum volatility, really heavy hedge fund rotation, and this massive post-close earnings divergence between Alphabet and Tesla.
Right. And third, we'll cover commodities, because there is a very real geopolitical supply shock driving Brent crude over $93 a barrel right now. We need to unpack how this alters the inflation calculus for central banks globally.
So starting with macro and global rates, because the cost of capital is dictating everything else on the board today.
It really is.
If we look at today's proprietary updates, the yield curve is sending a clear warning. The 2-year yield sits at 4.300%, and the 10-year yield is at 4.657%.
But the real issue is at the long end, right?
Yeah, exactly. The 30-year yield is the anchor here, and it has breached 5.148%.
Okay, let's pause and apply our first principles rule here for a second. Because the 30-year has now been above 5% for 12 consecutive trading sessions.
Which is the longest streak we have seen since 2007.
Right, so give us a quick, simple explanation of how a 30-year yield sitting above 5% practically impacts regular investors and the broader economy. Why should you care about this specific level?
Well, think of a 5% 30-year yield as a highly restrictive speed limit on the economy. It directly drives up mortgage rates, which heavily penalizes rate-sensitive sectors like real estate.
Right.
But for corporations, it makes refinancing debt significantly more expensive. Capital that a smaller company might have used for hiring or expansion gets swallowed up just servicing higher interest payments.
So it's essentially a structural drag on growth.
Correct.
But the confusion isn't just at the long end. The short end of the curve is showing some highly unusual pricing right now. I mean, the market is currently pricing a 33% probability of a 25 basis points rate hike at the July 29 meeting.
Yes. Pricing a 1 in 3 chance of a rate hike this close to a meeting signals severe market confusion regarding the Fed's reaction function.
It's like tapping the brakes while the vehicle is already navigating black ice. The market is pricing in a hike it really didn't expect simply because it fears the Fed is prioritizing this oil-driven inflation shock over slowing growth.
Indeed. And this tension is global. Looking at the international angle, the Bank of Japan is reportedly open to a faster pace of rate hikes.
Which they're basically being forced into.
Right, because the US dollar to Japanese yen pair just hit 163.15.
The weakest yen level since 1986.
Exactly. And that threatens the yen carry trade, which is a massive pillar of global liquidity.
Moving to today's data, let's shift focus to how this cost of capital dynamic is actively rotating equity portfolios. Because the equity market today is a classic split screen.
It is. The S&P 500 closed essentially flat, down just 0.14% at 7,498.96.
But that headline number hides a lot of defensive rotation.
Correct. Capital is hiding in defensive yield. Utilities XLU surged 2.25% today, and energy XLE gained 1.2%.
While the rate-sensitive small caps took a hit, the Russell 2000 dropped 0.92%.
Right. And we saw this play out very specifically in the financials today.
Yeah, let's look at Capital One, ticker COF. They actually traded down today, despite posting very strong return on tangible common equity metrics.
Hedge funds were heavy sellers there.
Right. And then you have Bank United Inc., BKU, which faltered significantly. They slashed their full year 2026 net interest income guidance.
Which the market just will not forgive in this rate environment. Moody's Core, MCO, also dropped 0.3% purely on reduced free cash flow guidance.
Yeah, any hint of cash flow weakness is fatal right now. Though conversely, CME Group did see a relief rally today.
Yes, institutional consensus confirmed there's no real demand for perpetual futures, so that regulatory overhang lifted for CME.
But the biggest flow story from our daily desk data is in the AI and semiconductor space.
Unquestionably. Hedge funds just executed the largest cumulative selling of U.S. information technology on record.
Which is a massive shift.
Right. They dropped net exposure from 26% down to 14%, but they are now stepping back in to buy the dip in semiconductors.
Okay, I have to push back on that, though. Are we seeing fundamental institutional conviction in these semiconductor names right now? Or is this simply mechanical short covering and, tactical re-engagement by hedge funds after a brutal momentum washout?
It is almost entirely tactical.
I thought so.
Yes, when net exposure drops that drastically, funds become heavily underpositioned. So when Advanced Micro Devices announces a major investment in Anthropic or Supermicro Computer Guides to record backlogs,
They are forced to buy just to keep up with the benchmark.
correct. It is forced buying, not a new fundamental conviction.
Which brings us to the mega cap post-close divergence. We had Alphabet, GOGL, reporting a massive beat. Cloud revenue was up 82% to $24.77 billion.
And a $514 billion backlog. It proves their AI capital expenditure is actually generating immediate revenue.
Right, but then you look at Tesla, TSLA. They suffered a severe profitability miss today. Operating income came in at just $398 million versus the $1.39 billion consensus.
Because their capital expenditure on AI and robotics is not immediately monetizable, in a 5% rate environment, the market demands immediate cash flow, which Alphabet has and Tesla currently does not.
On that point, let's pivot from the strength we saw in energy equities like XLE to the underlying physical commodities driving those moves, because the situation is escalating.
It is. Brent crude surged 2.41% today to $93.81 per barrel.
Driven by a very specific two-choke point problem.
Yes, the U.S.-Iran conflict at the Strait of Hormuz and a Houthi blockade at Bab el-Mandeb.
And our latest run of desk data notes that approximately 2.5 million barrels per day of Saudi flows are at risk here.
Which is fundamentally altering the inflation calculus. And this geopolitical risk is spilling over into precious metals. Gold rallied 1.31% today to $4,130.25 per ounce.
Which is a complete historical anomaly, right? Gold is surging purely on this geopolitical safe haven bid, and it is completely ignoring the massive headwind of real yields.
Right. 10-year real yields are sitting at a highly restrictive 2.37%. Gold should be struggling here.
But fear is overriding the math.
Exactly. And this energy shock is causing a ripple effect globally. The KSPI gained 0.74%, mostly on AI supply chain strength.
Costs be doing well, but oil importing emerging market currencies are getting crushed. The Indian rupee is selling off hard due to the energy shock.
Because importing 93 oil drains U.S. dollar reserves rapidly.
Let me ask a forward-looking question here regarding China, because our data shows China is buffering this energy shock right now by aggressively drawing down their fossil fuel reserves and heavily substituting with EV adoption.
Right.
So if China is artificially suppressing global prices by burning through their inventory now, what happens to the broader commodity complex when they are forced to restock?
Well, that is the core vulnerability. When China depletes those reserves and is forced back into the spot market to restock, they will be buying into a market that is already structurally tight.
Meaning a potential secondary price spike.
Correct. They are delaying the shock, not preventing it.
Understood. So let's bring all these narrative threads together into the synthesis. Because when we look at the entire board, we're dealing with a severe tug of war.
We are. We have an undeniable structural geopolitical supply shock driving up oil and rates.
Right.
And that is colliding head-on with a historic AI capital expenditure cycle that is actually bearing fruit, as Alphabet proved today.
And this is driving a major transatlantic divergence in the markets. European equities are outperforming U.S. markets right now.
Indeed. The FTSE 100 was up 1.24% today.
Because Europe is heavy in energy and defense.
Exactly. While U.S. markets are being weighed down by rate-sensitive tech and small caps.
Which brings us to the S&P 500 option structure from today's proprietary updates. Because the market is acting like a coiled spring right now.
It is. The spot price is pinned directly on the 7,500 volatility trigger.
But dealer gamma has thinned out at spot right.
Correct. That thinning prevented a violent cascade today. But the structure beneath is precarious. There is a deep air pocket down at 7,300.
Meaning, if we break below 7,500, there's very little support to stock a rapid drop to 7,300.
Yes, the dealer shock absorbers are effectively gone at that level.
It really feels like navigating this market is like trying to thread a needle on a moving train. I mean, The era of blindly buying the index on the promise of a clean, soft landing is suspended.
Completely.
Investors have to balance the supremacy of AI fundamentals against the structural headwinds of 5% long-term yields and 94 of oil.
It requires extreme selectivity.
So to quickly recap the core takeaways from today's deep dive for you. First, long end rates are structurally elevated, acting as a restrictive speed limit on the economy. Second, the momentum trade in equities requires selective stock picking amid massive factor volatility, as we saw with Alphabet and Tesla. And third, geopolitical risks have placed a firm floor under commodities. Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.